Hello traders, welcome to another masterclass. Today we're going to be talking about the most important aspect to your trading. If you're going to have a trading career, you have to understand risk management. So what is risk management? Well, risk in trading is everything. Okay, so let's start with a broker. A broker will give you leverage. Now what's leverage? Well, it means that if you say have £1,000 in an account, they will say to you, okay, you can risk 500 times your capital to trade, which sounds attractive, and it is. It's a great tool. It's a useful way to help you generate an income from trading, making good profit when you only have small accounts. Now they know that an average retail trader has a small account of maybe £1,000 or £2,000 on average, and then most will have less than that. You've got a lot of gurus out there that will be talking about how to turn £250 into £10,000 in like 3 weeks, and it's all just very ridiculous, and they haven't got your best interests at heart. The brokers, they haven't got your best interests at heart. And they want you to be able to trade lots and lots of trades, place lots of trades, because they earn commissions from that. The guys that promote these ideas, these gurus that say they're going to turn £250 into £10,000 in 3 weeks, well, how do you think they're going to do that? They're going to get you trading lots and lots and lots and lots and lots, and being able to really maximise this leverage that they give you, that the broker provides. So you could place one lot trades on £1,000 quite easily, which is say £10 for example, £10 trades. And the problem that I have with that is that you are risking £100 on a £1,000 account. Now it only takes a handful of trades to really devastate your account. Now for me, for this example, I'm going to talk about a trading account of £10,000, because when you come into this business, it's all very well starting with £30 or £50 or £1,000, but if you're going to make money out of this and you want to have a career or earn at least a good second income, you need to have money to start with. Now abusing this leverage will blow your account, quite simply. It doesn't matter what size account you have. If you hammer your account, you're going to blow it. Now for me, for many years I've been trading, and there was one thing when I went through a phase where I felt like I was in a hurry. I was in a hurry to trade, so I'd overtrade, I'd push, I'd maximise this leverage, and I found that my stats went down the toilet. Really, I'd end up having massive losses, and I had to remind myself that the markets are always going to be there. There's no hurry to trade, and you don't need to rush. And so having the correct risk management in place will see you right. So let's talk about risk to reward ratio, because that is really, really important. Now with a £10,000 account, I would say that I would use personally 1% of my capital on a 10k account. So I'm risking £100. And risk to reward ratio, we talk about this, and we're saying, right, if I want to risk 1%, I want to make 2% or 3%. So let's give you an example of that. So here's a real example of a euro dollar trade taken. The entry was 11205. The stop loss was 11160. So it was a 45 pip stop loss. So with a 10k account, we were risking £100. You can see that there, potential drawdowns £100. So going from 10,000 to 9,900. My reward, on the other hand, my final target was 155 pips up to that 76.4 at 11360. So £344 reward for profit based on £100 risk. So 3.4% return on a 1% risk. Nice trade, nice amount of profit, and that's the sort of setup that anybody would want to take as a trader. These are the sort of trades that you'd be looking for, right? Good small risk for a decent reward. So if you can get this right and you can do this consistently, I mean, you're never going to get it 100% right. You're going to have drawdowns. You're going to have terrible days where you might have 4 losses in a row. It does happen. It happens to me all the time. But it happens to me on on an account where I'm still profitable at the end of the month, for example. I'll say that again. So, I could have 5 losses in a row, and it does happen. I could have a really terrible day, but still be profitable. And that's because I have got this risk-reward ratio, correct and understood. So, using 1% risk on 100k on a 10k account is £100. So what's the worst that can happen? Well, say I do have 5 trades, 5 losses, and I was risking, let's say worst case scenario, say I was risking 10% on an account of 10k, and trading hard and not really respecting that risk is everything, not really appreciating this. So risking 10% times 5 bad trades, 50% drawdown, which is what, 5k. So I've got a 10k account, 5 bad trades in one day. It could happen in like half an hour or an hour, just moments of madness. Everything goes chaotic in the markets, which that these things do happen. Don't expect to have all the pleasure without the pain in this business. And, and all of a sudden you've wiped out half of your account and you think, wow, what just happened? So, massive drawdown. Now let's explore this if we're doing it correctly. Let's look about, let's look at let's say that, in order to get back to break even, you now don't need to make 50%. You basically have to make 100%. So I say that again. In order to get back to break even from this drawdown, you now need to make 100%, not 50%, to get back to 10k. So it's a massive journey. If you appreciate people like Warren Buffett, they've been trading for 30 odd years, and over a 30-year period, they've consistently been making, say, 20% a year annually. That's what they're shooting for. He's some of the best traders in the world. He's very well respected. He makes maybe 20% a year. He's got a massive amount of capital, and so for him, 20% is a lot. So you then wanting to make 100% returns in a matter of days or weeks, it's going to be a tall order. So looking at getting this correct, understanding that if we risk 1% per capital, and say we have a really bad day, and we say we have 5 losses, which does happen and can happen, and as I said, it's happened to me many times. That's 5% drawdown, which is £500. So on a 10k account, we're losing 500 quid. That leaves us, with £9,500 to play with. So it's not that bad. It's not so devastating, is it? So when you look at it like that, then you think, actually, yeah. So understanding risk and getting this part of your trading correct is really, really, really paramount to your success. And so let's look at stop losses now. Let's talk about what we did here on this euro dollar. Let's use it as an example. So this was the trade. Let me give you the actual trade idea, because we do post these signals and these trade ideas out to our groups, and this is what it would look like as a typical trade that we would shout out and say, okay, so euro dollar was a long, it was a buy at 112.05. The stop loss was 111.60. So for T1, we want to take some profit off the table. It just so happened to be a good 1-to-1 risk to reward. So T1, we take half off and then move our stop loss to break even. So we made 45 pips. With the stop loss to break even, it then became a risk-free trade. We could leave it to run on to our T2 for 155 pips in total for a good 3% return. That's a typical idea of a trade. Now you could argue, well, would that fully be 3% if we were taking some profit off the table? Well, it's a trade idea, and how you manage that position in terms of taking profit is really down to yourself. But it's not a bad position to be in when your only dilemma is, how much profit should I take? How much should I, how much do I want to make from this? And so not having to worry about any drawdowns and just seeing pure profit on the table, and then managing your emotions to say, okay, I want to let some of this position run because I want to maximize the profit on this. It's a hard thing to do. That is your emotional turmoil. But if that's all you have to worry about, it's not a bad position to be in at all. And remember, for all the technical analysis and all the fundamentals that you are looking at in terms of trying to make money, this game is always going to be about probability. So you have a probability of winning, sure, but no guarantees. So it doesn't matter how many confluences, how many reasons, or however your technical analysis is stacked up for your projections and for your predictions, it's always going to be about probability. So protecting your money, protecting your capital that you've brought on the table, playing defense, as the Americans say, and not offense, is paramount to your success. You get this right and you'll be able to be consistent, and not only that, you'll be confident enough in your trading to actually then top up your accounts and actually move forwards with a bigger account. Also, you'll be able to compound your account and actually start making some serious money. So you need to get realistic. You need to look at making small gains over time to grow your account. None of this what the gurus are promoting in terms of, you know, turning £250 into 10k. That's you know, you need to throw those ideas out of the window. Always have a stop loss. And so, talking about stop losses, here's something that you know, we've come up with as a stop loss table, as a simple way to help you with a couple of examples. So, it's example 1 with a 10k account, is example 2 with a 5k account. So, say you open 2 positions or 1 position, you want to take half off the table, like, as per, like, you know, this trade here with a T1 and a T2. It's always sensible to take profit off the table. That helps with your emotions as well in terms of greed. If you bank some money, bank some profit, it makes you feel better. It makes you feel at ease. If you move the trade, the stop loss to break even, and you run in a risk-free position, you've taken some off, it's fantastic. You know, there's nothing you need to do with that. You can switch off the computer if you want. You can walk away, go do something else. It's a great position to be in. So, you know, let's start with like the size of the stop loss. Now, the stop loss may vary depending on when you're getting in. So it could be like a 20 pip stop loss all the way up to 100 pip stop loss. If you're intraday trading, so you're day trading, you're not swing trading, you'd say on average maybe a stop loss might be like 30 to 50 pips. You can see in this case it was a 45 pip stop loss, which is an ample size stop loss, big enough stop loss, risking 1%. So let's assume that, you know, you've got a 10k account. You could potentially be risking on between sort of, well, £4 to £5 in terms of stake size, so lot size. So, you know, 0.4 to 0.5 in terms of your position size. So, you know, it's pretty decent trade, pretty decent amount. You've always got your stop loss in place. You've worked out your risk. That's it. It's done. So this is a really good guide, really good way of doing it. So, you know, I work with 2 positions, so I might do something like this. On £5, I might do £2.50 times 2 positions, open up 2 trades, and put the target on one of them at T1 at 11250 in this instance, and the next one at 11360. So this table's a really good way of sort of gauging how to do things. If you need a copy of that, I can always send you a copy of it, no problem, just ask. In terms of risk management, this is a bit more comprehensive. So a risk management guide, hopefully you find this quite helpful. So lot size, depending on the size of your account. Again, let's work with a 10k. So 10k, if we were using 100 pip stop loss, we would do 0.1, which is £1 per pip roughly. I'd have 2 positions on, so total risk would be £2 or 0.2. So what's my maximum drawdown? Well, it's £200 risk. So what am I looking to make? Well, if I was doing 2% risk on this euro dollar trade, I would be looking at 2 positions here. I'd be looking at making potentially £344 as a minimum, maybe up to about £600 if I take profit on one early. So yeah, you know, it's a really good trade. Or if I was simply doing 1% risk and taking half off the table, I'd still be looking to, you know, maybe make £200 to £300 profit on that trade, and risking, you know, £100 to £200. So that's the risk to reward ratio. Now it means that you can have a hit rate of, say, you know, say you've taken 10 trades in a week, you lost on 5 of those, and so your hit rate was 50%. If you're managing your risk correctly and you're doing, say, 1% or 2% of your capital, really you should come out profitable, because if you're risking 1% to make 2% or 3% in that, you know, in that euro dollar trade, for example, you do 5 of those winning trades like that, and you make 3% on each one. So 3 times 5 is 15% profit. Now, you've made 15% profit, but you lost on 5 of your trades at 1%. You've lost 5%. So what have you come out with? Well, net, you've come out with 10%. So 10 trades, and you've got 50% hit rate. So that would equal 5% drawdown. Okay, but profit would be 15%, wouldn't it? If you say, assuming that you made 3% returns on each one, even if you made, say, 2%, you'd still be then making 10% profit. So take away your loss, because your loss is always going to be fixed. That's important. Your profit will be whatever it is. It could be 2%, it could be 3%. You might even be able to leave a runner on to make 4% or 5%. That's what you're looking for in trading, isn't it? You're looking for these moves to happen, which they do happen every now and then, and it's great to get on them. But your risk is always going to be the same. Doesn't matter what you do, every time you trade, your stop loss should always be there and your risk should always be there. So in this example, if you were to have 10 trades and you lost 5 times, you lose 5%. But if you had 5 winning trades and you made 3% on each one, it's 15%, which equals 10%. So 10%, you've made 10% profit. Is that achievable? Of course it is. Does it happen? Well, yeah, for sure. If you've got a stop loss in place, then yes, of course, this is what you'd be looking at. So you want to work these numbers. Of course, it's never an exact science. As with everything in trading, it's all probability. There are never any guarantees. Always remember that. But the idea is to protect your capital. Protect the money that you have on the table all times. So always think about how much you are prepared to risk every time you take a trade. Don't worry about the profit. The profits will come. The profits will happen. In this one, for example, we were sitting and we got into this market. It dropped down into our, it was sitting in a drawdown when it first started. It dropped down to the 80s. So we were about 20 or so pips, 25 pips offside. And we were just sitting there thinking, okay, this is not working out. But were we worried? No. Had we already made a plan? Yes. Were we sticking to our plan? Yes. So what have you got to do, with this trade? Nothing. How do you feel? Well, you need to manage your emotions, and we're going to talk about that in our next session. We're going to start covering trading psychology, which is bring all of this trading masterclass to a head. That's going to be broken down into 3 parts, and it's really going to be something really interesting. That's going to be discussed in next week's masterclass. Start talking about psychology, because having all of this information is all very well. Having high probability strategies, again, all really good. Having a good hit rate, and maybe being 60% successful or 70% successful or 80 or even 90% successful is all very great. But understanding you can have all the pleasure, but you can't have all the pleasure without any pain. And it's when you have those painful days, those mistakes that you've made, which we all make. It's how you manage them. Now, if you haven't got a correct risk to reward ratio in place, if you haven't got your risk sorted, and understanding that risk is everything, then you're going to really struggle with managing your trade. So we'll cover that next week. We'll start talking about trading psychology. I hope you found this simple risk management masterclass useful. Really basic stuff, I know, for some maybe, but it's just really drumming it home that you need to understand that you need to have a stop loss in place, and you need to be able to use the correct risk every time you trade. To join our VIP chat group, premium group, it's currently open to everybody. So we've got about 140 real traders, so it's not just junk and spam. We've got a good bunch of people sharing their charts and analysis. A lot of good stuff going on in there. We also have the VIP group as well. That's open to everyone as well at the moment. So all free. It's got about 114 subscribers. It's a good bunch, good community. So if you want to get involved in that, it's all free at the moment. Just click on the links provided below, and you can have instant access for free.